it has been a while since my last stock valuation because I see the stock, I found that most of them are overvalued. And I'm not only mean that the big sevens are overvalued, but nearly all the stocks are overvalued. On September 10 last year, before the Oracle earning report, I updated my Oracle stock valuation and I predicted that the price to buy the Oracle stock is about 161, and the price to sell the stock, the price the traders, investment banks will push up to is about 300 to 400. After that, the news has been booming with things like Oracle took too many debts. But even if they took many debts, I still can update. So about 1 month ago, I update that the value per share decreased to 140. As you can see, after my valuation, the Oracle stock has gone as high as 345, but decreased over 40% to lower than 200 after that. For this moment, for me, it is nothing, right? Because it's match my prediction and just buy when the price to reach my valuation again, or sell when it's reached to my target. But in this video, I will explain how much I think the Oracle works at this moment and to incorporate the large debt and capital expenditure that the company have. If you have been watching my video, you always can see that this is my free cash flow model. In this model, I predicted the company's future revenue growth, future earning, operating income, how much money they can make, and also the reinvestment, how much money they need to put back to the company. And if you see the line item, you can find that first we have the net capital expenditure. Capital expenditure means the fixed asset the company spends, like the factory, the equipment, and it's net capital expenditure because the company can use depreciation to reduce their tax. And after that, we have R&D, the research and development, and the acquisition. And if you read my previous post or watch my previous video, you know that I found that the major driver for Oracle growth is the acquisition. So I just estimate the future acquisition, and I based on this scenario and predict its future value. However, something changed in the past years due to the AI bubble, or someone call it AI boom. If you see the capital expenditure, this is how many percent of revenue of Oracle goes to the capital expenditure. Before last earning, the Oracle capital expenditure is about 13% of the revenue. However, as you can see from this graph, Oracle has been burning money on the capital expenditure in the past 2 years. It's increased to 30%, 50%, and for this most recent 2026 guidance, the capital expenditure is close to 70%. There's no way that the company can maintain that capital expenditure forever. Why? If you see here, we have the operating margin. Operating margin means for each dollar of revenue the company, how many percent of those revenue will transfer to the income, to the earning, to the profit. And you can tell that at this moment, Oracle made about 36% of their revenues as profit. This is comparatively high operating margin compared to other companies. However, if the company has 70% capital expenditure forever, there's no way they can still maintain the high margin because they also have other expense, right? So what I do is I suppose that from now on, the Oracle gradually decrease its capital expenditure over past years. So what I do is I expect that they will decrease to zero in year 5. So for every next year, I will subtract the fifth of the 70% and zero. So the next year, I will subtract fifth of 70% and then fifth of 70% and so on. Then you may wonder, why do I set it 0%? Before I talk about that, I will explain some important concept in the business and finance valuation. So these two graphs shows the testosterone level and estrogen level for male and female. as you can tell that they start very low, but as we reach puberty, it will gradually increase and is achieved to the highest point when we are about 20 years old. But after that, the testosterone and estrogen will gradually decrease, although they still maintain quite a level of testosterone after the age of 30. While female after 50, their estrogen level is close to zero. That's probably a scientific evidence for older man and younger girls marriage, right? As scientific support. But what I want to say is just like a human, when we're born, we're just a baby, and as we grow up, we made mistakes, but we also have the courage to do things. But as we grow up, we stay energetic, we can be more productive, but the mistake we made will be fewer and fewer, and we steadily grow in our career. However, after the middle age, we kind of steadied and we start to decline. We cannot stay up late as before. We get tired easily. We probably start to have back pain, and we do not make as much as before. The money we spend probably also become lower, right? Because we cannot eat as much as before. We cannot go out as much as before. So just like human, business are also the same. They also have such a business cycle. When they just start out, they will lose money, of course, and they make many mistakes. Some of them go bankrupt, but those who stay alive, their revenue will gradually increase and their profit will gradually change from negative, from losing money to positive. And after that, they will have a period in which their revenue growth is high, their operating growth is high, and they also need to keep investing money. But over time, there is a point that the company will be mature. When they mature, their revenue will either stable or decrease, and their profit will also be flat or decreased. But at the same time, their investment will also decrease. Just think about a company like Procter & Gamble, or think company like Heinz. They have been matured. It's unlikely that they will go bankrupt, but it will not be wise for the management to spend $1 billion to invest, right? Because the will not expect they will have a high growth. In fact, for companies like Kraft Heinz, the company selling ketchup and the cheese, if I value those companies, I may expect that their revenues and profit will decrease as fewer and fewer young people will buy their product. So that's why in my evaluation, I gradually decrease the Oracle capital expenditure and acquisition after the year 5. But you may wonder how I get 0%. Just like when people are young, they are different, but when we are aging, we are similar. Just think about old people, right? No offensive, but have you realized that the old people, they look similar? Because as we get older, our face become longer and our skin aging, and that's why. So like when people get older, they become similar. The company they may start different, but as they are aging, they will become similar. So that's why I found the company similar to Oracle, and to calculate their capital expenditure to revenue to see in the industry how many percent of their revenues goes to the capital expenditure. And you can tell that here we have like Microsoft, IBM, Salesforce. The median for their capital expenditure to revenue ratio is about negative 0.68%. The reason you have negative is the company can claim depreciation, the decreased value of assets, to reduce their tax. When the depreciation is higher than the current year capital expenditure, you can have a negative ratio. That means that in that year, the capital expenditure and the net capex will save the company's value. So I just try to make it easy. I expect that over time, the company's capital expenditure ratio will decrease zero. And I'm not saying that the company will stop growth or stop investment. As you can tell, that the next year, the capital expenditure will be 65% of the company. And the 2027 it will be 50% of the company. It's still a very high ratio, but I just expect that will decrease. After I do all of this, the value per share, if the company have spent about 2,000 millions dollars per year, is $85, and the value per share if the company spent about over $3,000 million is about 111. You may wonder how do I get this 2,000 and this 3,300 millions. You can read my previous post or watch my first video. What I do is I collect over 60 companies that Oracle acquired in the past decade, and I estimate how much they spend, how much for each of them, and I get the median for the past 10 years and 20 years, and that's the value I got. As you can see here, when the Oracle invest more, they spend more money, but they also have more growth. That's why the stock value is also fair. After I get all of them, the median value I got is about $96. The $96 is I'm going to buy more Oracle. The next step is decide when to sell. You may find there are many ratios, many terms here, but don't worry, I will explain that. The value per share is how much the money worth depends on how much free cash flow the company will generate in the future, just like I evaluate. But the price per share, the how to sell the stock, can be affected by traders, by investment banks. They do not do the valuation. What they do is they compare the company with others. Just think about when you want to sell a second-handed concert ticket or second-handed football ticket. You are not set the price based on how much you buy. You are setting the price based on how much else is selling, right? 100% football ticket can be as high as 500 if many people want it, or a 100-second ticket can be as low as $50 if a key player got injured and cannot play. So that's how the traders, how the investment bank like JP Morgan, Stanley, Goldman Sachs, they decide the price. And the ratio they use is a P ratio. It's a stock price over earning. They will estimate the company's price over earning for the future, and they will compare the P ratio with the industry. And as you can see, in my last evaluation, when the Oracle is going very high when people are in the AI boom, I collect data from things like Yahoo Finance, CNBC, Wall Street Journal, Morningstar. The median P ratio is about 34.7 here. And this data are ratio I got from the NYU Stern Business School. The current P ratio is the P ratio for the software cloud services business industry at that moment is about 180. The aggregate market cap to the net income is to add up all of those companies' market capitalization divided by all of their net income is about 41. The forward PE is the traders in one investment bank's expectation for future is about 51. The trading PE in my last evaluation is about 203. That is the P ratio for the cloud business industry in the past 12 months. In my last evaluation, I estimate the company's net income for the next 10 years, and also that I can know their earning per share. And I use that to multiply each of those P ratio so that I can get a sample, a side of how much price the trader can set in the future and get their median. But what I do is the money in the future worth less than money at right now. So what I mean by that is if you sell stock 400 after 10 years, the money probably worth less than selling the stock 300 right now, right? Because the inflation, and you can also invest the money in other place, and divide those future value to today. That's why you can see in my last valuation, the price I set to sell is about 300 to 400. But then I realized that this is so different. And if I just mix all of those price, I may inflate my price to sell. So what I do is like I get the median P ratio at this moment, and I gradually decrease or increase to the industrial average so that I can get a comparatively reasonable price target. This is the median P ratio I got from agencies in my last valuation. And this is the median P ratio I got from current. So when you use those P ratio, just two or three difference can lead to 10% or 20% price difference. So that's why people say that the stock is volatile when you are trading, when you are priced based on others. But I do not use that to decide when to buy. I just use that to decide when to sell. So it's okay. So as you can see that here, I just gradually increase the current P ratio to the industrial average, and I multiply this earning per share. And the price that I try to sell at this moment is about 288. And one question you may ask that, what if you sell a stock and it's increased even higher? Or if you do not sell the stocks and then it's decreased. So that's why whenever I sell stocks, if it reaches to the price I estimated, I will sell half of them. And if it's going even higher, I will sell the rest of the rest. So by doing so, I have some money in my pocket. And so it goes higher, I can keep selling rather than missing the opportunity or regret. But if it decreased, I would say I already collect some gains. So I'm okay that the stock decreased. So by doing so, you will not have to bear the effect of regret because regret can be really detrimental in the valuation in the investment. What usually happens is when the stock goes high and the people do not sell, they will feel regret when it decreased and buy more at surplus and vice versa. And if you see the news, you may find that people always talk about Oracle has been taking too much debt and it's a big risk. But that's not the big problem, right? Here you can see that I estimate the cash flow, I estimate the price value of cash flow, and then after I got the company future value, I always subtract the debt and add back the cash, and I also subtract the stock options that the employee have, and that divided by the stock share. So when people see that the Oracle has addition 18 billion debt, I just add the debt to my valuation. I still get a number. I do not sell stock or buy stock just because new. So this is my valuation at this moment. Feel free to ask questions, to leave comments. Thank you.